Yep. Hello, good morning, everyone. We are gathered here for the shareholders meeting for year 2013 for the Athlete Shoes Limited, which our company name. My name is Rohit. They are my colleagues Gurpreet and Anuj. I am the marketing manager of the company. Gurpreet is operating manager, and Anuj look after the financial decision. First of all, I'll talk about the executive summary of our report. So initially we started the earning per share of $2.5 in year 10, and throughout the years we had some fluctuations in the earning per share, but in 2013, after exceeding the investor expectations, we are having the earning per share of $4.48. And if I talk about the return on equity, investor was accepting 15% from us, but we almost increased to 6%, which is now 20.8% in year 2013. And our return on equity got increased because of increase in profit, which is 42.31 million by the end of year 13. Also, the stock price got double by the end of year 13 from investor expectations because of our credit rating increased to A. Also, the image rating we having it 70, which is also meeting the investor expectation by the end of 2013. So strategies and policies. We applied the product differentiation and competitive price strategy. We providing our customer a different product but competitive price. And our main focus on the revenue maximization, efficient production and distribution from plants to warehouses, and also the utilization of spare capacity for production of private label shoes. And for the marketing, we are offering 200 models of shoes, and we having the 5-star SQ rating by the end of year 2013. Price per pair in internet segment is $67, and the wholesale segment is from year 11 to 13 is 40. We kept the 43 to 49, and we also giving the delivery time of 3 weeks to retailer, and the retail support of 500, and the rebate offer of $1 to $5 per pair. For the marketing, so I'm gonna talk about how much we spend on advertising. So we having the how much sales we got for the year 10. We spend like 21 million on advertising, and we having the 239.14 million sales. But in year 11 we didn't have good profit, that's why we didn't spend much on the advertising. But in year 12 and 13, as I told you, we had the good profit, so our sales got increased to 306.59 million. So now I'm gonna ask my friend Gurpreet to explain further for the human resource.
Good morning, everyone. I'm Gurpreet Singh. I'm the Human Resources Manager for Athlete Shoe Company. So I'm going to talk about human resources and operating things. So I'll start with the base wage increment, which was 1% per annum for our company, and the incentive pay per pair was $1.30 for North America plant, and for Asia Pacific it was 50 cents, which was increased 15 cents from the last year. And the best practice training for North America plant was $1,300 per workers for just North America. Even for the Asia Pacific, it was the same, like $1,300 per worker, which was overall increased by $300 from last year. And our Six Sigma TQM quality program for our company was 50 cents per pair, like for year 13. And I'm going to talk about the total compensation per workers. So for North America in year 13, we had like $21,500 for North America and $4,300 for Asia Pacific, which was more than like in year 12, 11, and 10, as we had like 21,300 in North America in year 12, and for Asia Pacific it was $3,800 for year 12. And at North America and Asia Pacific plants, the total compensation increase was due to increase in productivity and the incentive pay. And now I'm going to talk about the operations. So I'll talk about the productivity for pairs, workers, and years. As for North America, in year 13, the productivity was 4,062, and for Asia Pacific, it was 2,482, which was increased from the last 3 years. As we had only 4,000 in year 10 for North America, and in year 11, it was increased a bit from 4,000 to 4,005, and in year 12, it was 4,033. So even in Asia Pacific, we had in year 10 we had just 2,500, but in year 11 it was decreased to 2,490. But again in year 12 we increased it to 2,453. But in year 13 we increased it to 2,482. And the reject rates for our North America plant was 5% for year 13, and for Asia Pacific it was 6.4% for year 13. Like we decreased the reject rate a lot for Asia Pacific, and this helped us a lot. Now I'm going to talk about the branded production cost. So for North America plant, it was $26.64 per pair for in year 13, just for North America plant. But for Asia Pacific, it was $20.24, which was less than the last 3 years. And now I'm going to talk about the plant capacity utilization. So for year 12 and year 13, for both, we used 120% for as a plant utilization for both the plants for North America and Asia Pacific, which was way less than the last 2 years, like in year 10 and year 11, which was 107.6% in year 10, 107.6 in year 11, but it was increased to 120% in year 12 and 13. And even for Asia Pacific, it was 88.2% in both the years, year 10 and 11, but in year 12 and 13, it was increased to 120%. So now I would like to call my colleague Anuj for the further. Thank you.
Morning, everybody. As a financial manager, I will talk to regarding some of the key factors regarding financial ratios. So, as you can see over here in the current ratios, because of the increase in the assets and decrease in the liabilities, our current ratios increased to 4.07 in 2013. From the 2010, it was like 2.35, and similarly in debt to asset ratio, we have like in year 13 it's 0.17, and which was like in year 10 it was 0.38, which is decreased because we can pay our the assets, whatever the debts on the asset, we can pay it really quickly now. And the interest coverage ratio is also has increased like 12.77% in year 13, which initially in year 10 it was 4.74, and year 11 was 4.12, which was decreased, and year 12 was like 7.42. So we are able to pay off our interest on the whatever of the liabilities, we can pay the interest more frequently. And the default risk ratio has increased to 3.97 from 1.70 in 2010. So we can pay, like if there is any risk ratio, we can pay it directly. And now I'll talk regarding the revenues and expenses for the years. If you can see in year 10, we have just a revenue of 239.15, which decreased in year 11 due to our like profit decrease and the revenue decreased. So 216 in year 11, and there was a good increment in year 12 to 310.15 million, which obviously decreased in year 13 to 3.06, but due to the expenses has decreased also in year 13, our net profit has increased to like 13.8% from 9.8% in year 12. So if you can see the net profits, in year 12 it was just 30.32, where it was in 13 it was like 42.31. So it was a good increment for us. And I'll talk regarding the finance, the earnings per shares and the dividends. So in year 10, we tried to give the dividend of $1 for the earnings per share of 2.5. But due to some problems in the financials in year 11, we were not able to give any dividend out. But which we changed to year 12 and year 13. Like year 12, we give $0.25 dollars dividend in year 12, and year 13 it was like $1 for earnings per share of 4.48. And the cash balance still we have like 26.086 million after paying all the dividends. So these are some target for the future. If we are going for the future plans, we want to increase our sales and want to we are working on the credit rating to increase it to A+, and also we want to maintain the image rating as per the expectations of the investors. So obviously we will be planning to pay off all the loans and everything to make sure the credit rating increase and investors are willing to give us some more investments. And maintain expenditure on best practice training. So we will be paying the more like best practice training so that we can get more productivity. Decrease cost of productions for increased net profit. We are reducing the production cost and we want to increase the profit. And further maximizations for the shareholders' value and higher dividends will be paid out. Thank you so much. That's from my side.
Yeah, very good.